You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. Be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. Welcome to TWIFO, This Week in Futures Options, a program where we break it all down. The week that was and indeed still is on the futures options side of the fence. We're getting started a little late, so we're going to dive right in. And joining me to help me do just that, first off, let me welcome on the first man of Illinois House District 48, a.k.a. Mr. Nick Howard, the founder of Bantix Technologies and creator of a little program we like to use around here called Quick Strike. Mr. Nick, welcome to the show, and congratulations on the big victory there on Tuesday in the Howard household.
Oh, thank you very much. I'm not sure how much politics we should talk on here, but we're definitely excited on our side and look forward to serving the state of Illinois much more than we already do.
We will talk zero politics outside of the fact that maybe your nickname is now the First Man, because I kind of like that. Mr. First Man.
I'm going to make a documentary about it.
You're already picking out your drapes for the West Wing and all that good stuff. Pick out your educational platform, what you want to teach the kids when you read to them in the kindergarten, all that good stuff. All the First Man platform stuff you'll have to do very shortly. Also joining us from the magic of telephone, our old friend, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Sean, welcome back to TWIFO. Sure.
Mark, great to be here. Nick, congratulations to your wife as well. Excited to be here. Lots of stuff going on in the market, so looking forward to a fun discussion today.
I miss having you to my immediate left, sir, so we'll have to get you back in studio one of these days. It's always fun to have you chiming in with me here live in the studio. And also joining us, holding down the CME Group hot seat today, appropriately enough, it's another CME guest. He's a first-timer on the program. He is Albert Eng, the Director of Metals Products over there at CME. Albert, welcome to the TWIFO program.
Hey, thanks for having me. Really excited to do this.
And Albert, as we are wont to do with all of our first-timers here, why don't you give us a little bit of a brief overview of your background in the options space and how you found your way over there to CME?
Right, yeah, so thanks. So much like a lot of the product managers here at CME, my background was trading the direct product that I'm now managing. So I started my career in about 2006 in the pits here in New York in the soft commodity options and made my way eventually to start trading gold options, which is now my flagship product that I manage. So pretty familiar with what Open Outcry used to look like. Very familiar with electronic options trading, and on a day-to-day basis, I'm out there talking to clients, interfacing with what the market needs now, and basically trying to figure out what we can do to improve liquidity and make the markets better.
All right, everybody. Now let's get the ball rolling. Albert, since this is your first time here on the program, and since you're a metals guy, why don't we start? Why don't you give us a little bit of an overview? We had Derek on not too long ago to kind of give us an overview of kind of the highlights in the option space overall, but maybe give us some highlights that are in your purview recently out there in metals land. What products have been lighting it up, and what trends are you seeing out there, volume and volatility wise?
Yeah. So thanks. So obviously, when we're talking metal options here at CME, our flagship product is gold, and it's something that's globally relevant. It's had a great growth year. Year over year, we're up about 17%, trading close to about 49,000 options a day. We had an especially good month this past October with volumes growing about 40% over October of last year. And in just the global backdrop of what's going on right now, gold has been particularly relevant to the markets in general. But one of the things that we're really trying to focus on in the upcoming year is drawing attention to the fact that we're really growing our liquidity in the short-dated options. So those are the weekly expiration Friday options, which have been doing very well for us. So those have grown from roughly 200 lots a day about a year ago to now north of 2,500 a day. So that's becoming a very, very relevant product, especially to guys looking for flexibility. And one of the other things that we're really working on in the space of gold specifically is trying to bring it so that the liquidity that we enjoy here domestically is just available around the clock, so that someone can log on in the middle of the night and still be able to reliably trade a gold option. So those are the longer term things that we're trying to work on. And I do have some kind of contract spec change that we've recently done. But in terms of vol and kind of like open interest and paper flow, we really haven't seen too much action, especially this recent week. We just saw the FOMC announcement go by, and it was kind of a non-event like everyone anticipated. But one of the things that it's been pretty surprising is just the vol environment gold has been in, and this is probably a common observation on the show, that across all commodities, volatility has been in a low range. So with all that's happening in the world, you would expect that maybe gold would be more of a safe haven demand type asset. But we haven't really seen all that much demand for gold as a kind of tail risk event hedge. And one of the things that might surprise you is that, just the other day I was talking to a colleague of mine, and we were looking at 30 to 60-day vol, and it was priced right around 9.5 to 10.5%, which is about between 1 and 2 standard deviations away from the 5-year average. But then looked at the 1-year volatility, and it actually was very close to what the 2-month was. It was right at 10.5 to 11.5%. So really the spread between short-dated and long-dated vol is one thing that we've really noticed. And then in addition to that, the risk reversals. So I kind of did an exercise recently where we looked at risk reversals, and we noticed that kind of in a time where gold is on a downtrend, as you would expect, puts are bid over calls. But what we've really noticed in the last, I would call it 24 months, is that we're rising again to where calls are being about 1% to 0.5% bid above the 25 delta put. So we're starting to see there's more of an upside demand for calls, and we're seeing puts being, if not flat to the at the money, pretty close to it. So we've noticed that there's a little bit more interest to the upside, but it's not always an indicator that the price will go there in the near future, at least.
Yeah, that's why I like talking about gold, because you do see a little bit of evolution in the skew. It's not like some of the products where it's kind of the same skew all the time. You'll see it move around a little bit. The puts will get bid, the calls will get bid, vice versa. As you see things moving around, it's more of a reflection of direct underlying sentiment. With some of the broad equity indices, for example, the puts are always going to be a bid, just a question of how much. So it's nice. That's why I kind of like talking about gold. Since you brought up gold, maybe we'll start off in there, like you mentioned, kind of a little bit of a retracement this week out there in the broad gold land. Gold right around 12.25 or so coming into showtime, so off a little more than 0.5% this week. You also talked about the vol. The vol kind of coming back in pretty hard this week. So yeah, this has kind of been an issue for a long time. People who are looking to buy gold vol and hoping that it pops. It pops briefly, and then it comes back in just as quickly. So it's very much a catching the fallen knife. I know Nick has alluded to, there is enough movement out there to do some scalping. So maybe I'll let him allude to his favorite options and futures type play in a bit. You kind of broke down the skew a little bit. I'll let Nick kind of dive into that in a little bit as well. So I'll just break down some of the top things we're seeing out there right now in gold land. I mentioned 12.25 is about where we are coming into showtime, listeners, and it was the 12.5 calls that were leading the dance out here this week in DEES. DEES 12.5 calls, pretty straightforward, near out of the money calls, lighting it up to the tune of about 5,300 contracts this week. Lion's share coming actually yesterday on Wednesday, about half of that volume coming on Wednesday. So that was the big dog out here this week. Number 2, the 12.20 puts, very near out of the money puts. So a little bit of maybe near term hedging or specking going up there. About 3,600 of that going up this week. Pretty much back and slightly opening. So a lot of back and forth, it sounds like, on that strike, which isn't that surprising. It's kind of a near at the money / out of the money strike out there right now. Coming off number 3, the calls still getting some love as well. Number 3, the 1300s with about 3,400 contracts open there. The lion's share going up on Tuesday, about 2,100. Actually, a good chunk of that closing, about 1,200 closing. So maybe some people getting the heck out of Dodge here in the far, far upside in gold options. Speaking of far, let's go out a little bit down the strike chain in the old quick strike. By the way, cmegroup.com/TWIFO, the place to go if you want to follow along with the reports, or just log in via bantix.net there. You'll see, if you do that, the 13 halves in DEES, also pretty active this week, all the way out to DEES 2019, actually, this time, doing about 2,000 and change. Also the same day, the 1600s traded 1,000 times. That would be a weird ratio if that was the case. Both on Tuesday, 2,000 of the 13 halves, 1,080 of the 1600s. That would be a funky 1x2 if that was indeed the case. So maybe some weird stuff afoot. Speaking of weird stuff, Mr. Nick, I know you love yourself some gold. What was catching your eye out here in the shiny stuff this week, sir?
Right. I don't know if Albert, I see Albert quite a bit out in New York. I don't know if he knows how much I talk about gold on this show.
You talk about gold. You make sure it's on every week.
I love talking about gold, and I love talking about copper now lately because we're getting a lot of interest from people wanting to hear about the copper volatility data that CME and QuickStrike have available out there as well. But just jumping over to gold and taking a look at things. So, as Albert mentioned, where the calls were firm to the at the money and the puts being offered, we saw that kind of give back a little bit with the vol coming in this week. We definitely saw the whole curve just kind of change shape a little bit as well. So if I go out here and look at I'll go look at the January contract, since that's right in the middle of that's about 48 days, so it's right in the middle there. If I take a look at that, we're going to see that the curve, the calls are definitely offered from where they were last week. They're still firm to the at the money, and the puts are, a little, a little less cheap than they were last week as well. So a shift not only down in the at the money volatility itself, but a change in the shape of the curve just a little bit. Now, again, when we're talking of these low volatilities, when you start changing something by percentage amounts, you're getting really, really small shifts in the actual absolute volatility levels. But this is probably as low as vol we've seen in a little bit of time. And we talked about this last week or over the last couple of weeks, where if you got the follow through to continue, then we might see some increase in the volatility. But really, what we've done here is we've kind of slid back down not quite into the middle of the range that we've been working on, but almost into the middle of the range, which is going to make for kind of a disinterested party, because we're not able to get out on the upside or break through on the downside. I don't think we're going to see any breakthrough on the downside. So we're starting to reach those levels again in volatility, where if we start to trickle down more in the futures, that whole and get towards the bottom of that range with these low volatilities, we're going to start to really want to pay attention to those gamma plays that we've been talking about, where we buy some cheap strikes and hedge them and hope for a move back up within the range. So when we start, what do we got? The 20-day volatility is, which is the D's contract, is 9%. So, I mean, Albert, I don't know if I could look at this historically, but I mean, these are pretty low. Have we been below 9%? No. When's the last time we've been below 9% historically? I don't even know if that.
Yeah, it's been quite some time. I mean, this is 2 standard deviations to whatever the 5-year norm is. I mean, I'm just trying to pull it up quickly, but I don't believe we spent a lot of time, if we have ever spent too much time, at the 9% range.
Yeah, I mean, we're down there pretty good. I mean, we've been pretty flat in this Jan contract. Not too much interest, but yeah, when we start to get really below here, you got to pay attention. And again, you pay attention for a couple of reasons, because there's been movement within that range, so it's tradable from a gamma standpoint. And then you get down to the bottom parts of these volatilities, you have to believe where there's the potential for you not to get hurt that much if you're long, hoping or playing for either a significant vol move or just movement in the futures itself. So that's kind of what I'm seeing. But Albert, I love talking about gold and talk about it all the time. One of my favorite products.
It's funny. I think the last time I don't think it was quite, I don't know if it was at these levels or not, but the last time I recall gold really hitting historic lows and people coming on to talk about it on the network, it was a few years back when Eric Norland, I think he was new to the research team then, and he put out a paper called Gold Storm on the Horizon. And he was predicting maybe a return to higher levels of gold implied volatility. At the time, gold was very anemic, and I often joke it was one of the best time research reports I've ever seen, because literally the week it came out and we were talking about on the show was the week gold vol kind of just exploded. So who knows? Perhaps I think recent history has shown us that gold vol is not prone to explosion, at least not any meaningful long-term explosion, at least in the recent past. But that, of course, all things can change. But it has been an interesting story to watch gold volatility out there of late. Well, Albert, since you're our guest, we're going to do a deep dive into metals today. So I'll let you have pride of place. I'll let you pick where you want to go next. You want to go into more precious, shiny stuff like silver? You want to get into maybe copper, some other lesser heralded metals? Where would you like to go next, Albert? The floor is yours.
Let's stay on precious just maybe like a couple more minutes, and then I'd really love to dive into copper. But I really wanted to try to point out one of the changes that we made to the contract. It was actually early this year, and this was a move that eliminated contrary instructions on the day of expiration. So it's not always that obvious to not frequent traders. But what that basically means is we removed the ability to elect to exercise an out-of-the-money option after it had expired. So we did that in gold, silver, and copper, and it turned out to be something that a lot of the market wanted to see. And from a market maker in a former life, I really appreciated. I would have appreciated that change. But what it really did is it really opened up the ability to trade strategies that are dependent upon expiration. So one of the things that I wanted to talk about today is one. I'll give a quick example of what contrary instruction used to look like. So let's just say today was the expiration for gold options, and we settled very close to 12 and a quarter, and you were short the 12 and a quarter call. You pretty much had to guess between 1:30 settlement and about 3 or 4 p.m., which is when you had to notify your clearing firm whether or not you wanted to exercise or abandon something. You would basically have to wait to see what futures did for another hour and a half to 2 hours before you knew what your short position was like. This basically made trading from the short side kind of a nightmare, because let's just follow the example. You're short the 12.25 call, and then let's say between 1:30 and 3 o'clock, we go all the way up to 12.70, and then we go all the way back down to 12.25. You would then be left guessing, well, did someone elect to exercise me on the short? So let's just say you did or you didn't. It just put you in this place where you were guessing about what your delta was, and it was just not very good for the market as a whole. What we did to eliminate it really opened up the ability to trade butterflies into expiration. And this is something we used to do in a former life of mine when we kind of ran like a CTA type strategy. What we would do is collect a little bit of edge. Maybe we would put on a call spread, and then if it went into our favor, we might turn it into a butterfly at maybe cost neutral, and just wait to see if it actually lands within the range that we'd like it to. But trading a butterfly into expiration when you can or cannot be, may or may not be exercised on the short, was very, very difficult. I found that eliminating the contrary instruction and knowing what exactly your delta would be at the moment of expiration really, really opened up the ability to trade butterflies on the close. So one of the things I was kind of playing around with today, and I threw it into my quick strike just to price it up, like the 12, 25, 50, 75 center call fly. So this is just kind of saying that you think that perhaps the contract will settle around the 1250 strike. It might make a little bit of sense because there's a lot of open interest there. You would basically be paying $5 and change. And if you guessed it perfectly, you could make almost maybe $20. But now getting out of the position is much easier than it used to be. And I don't know if, Nick, this is something you used to do, but I was talking to Carrick, one of our other colleagues, and he used to love to do this all the time. Any experience on your take on this?
On the butterfly strategy itself?
Yeah.
Yeah, I mean, I like the idea of starting out with one spread and then turning it into another. Especially, it's a way to sort of take some edge out of the trade, like you said. We did a lot of butterflies in the Eurodollars because it was easy way for you to trade in and out of the call and put spread. So I think that I like those kind of strategies where you build on top of one, and also where you're able to have a good idea of what your risk is going to be. Because I know that, not that I was ever a broker, but I know that a lot of my broker customers talk about people doing butterflies like that because people like to get odds when they put on a trade. So they like to be told or get a return of odds. So they say this thing is 8-1, so you're going to pay 3 to make 24, something like that. So I like those kind of things. And actually, I had seen that notice about the change in the contract, but I don't know if I necessarily paid attention to it the first time so much. But I think that's the contrary instruction thing. That's great, right? Because that does change the makeup of the trade entirely. If you know or don't know something's going to happen, I mean, you're not going to do the trade. It's just too much. It's just one more factor that you can't control as part of the risk. So does that exist in other stuff still, or I mean, how many? I think some of the ags got contrary instruction, don't they? But is that it for the metals? No other metals have it, right?
Yeah, so it's something that we were trying to kind of harmonize in the long run, but as it stands, FX options, almost all metals options, and nearly all energy options have eliminated it, and we're evaluating in the future what ags and rates and equities will look like product to product, but it's something that we think is overall positive for the market.
Yeah, for a lot of our equity options traders, maybe the analogy is kind of eliminating some of that pin risk. That's, people have that same fear, the stock settles out at a certain place, you're short, you don't know what the heck to do. This kind of eliminates or alleviates some of those concerns out there in the metal space. Since we're talking the precious stuff really quickly, I just did a quick scan here out in the other precious stuff known as silver. We talk about it every now and then here on the show. And ironically enough, the silver, of course, still in that 1440 or so range, off another 2.5% this week. So not a good week for the other shiny, precious stuff here. But the weird thing enough, the big trade out here in silver options this week, I said it's about, we're shy of the 15 handle in the futures right now, are the Dees 2019 30 calls, 1,288 of those going up this week on, I believe it was a Wednesday. 644 that opening, so half of that opening, which is a weird number in and of itself, but still about 1,300 upside, far upside, pretty much more than doubling calls going up by Dees of 2019. So fascinating stuff. We've seen some of these similar type trades out there at crazy upside in gold land. Obviously, some weird things would have to transpire for those to pay off, but weirder things have happened. Albert, like we said, we're kind of continuing our deep dive into metals. So we'll tell you, I'll give you a couple more swings at the bat. How about that? How about what's another metals product, maybe less heralded, we don't get to talk about on the show, maybe something in the more less precious, more production type side that you'd like to see us discuss on the show today?
Yeah, so Nick alluded to it earlier, but one of the things that's really excited us here at the exchange is the growth of our copper options. And this is, it's a long-standing product that's only really begun to get traction in about the last year and a half. Our copper future complex has been quite robust, and basically that's a very global market, fantastic liquidity throughout all kind of hours of the night. And what we've really wanted to do is try to bring the option community to start really getting involved in copper. The underlying has a lot of global macro significance. And I'm pleased to say that in the last year and a half, we've kind of grown that product from about 200 lots a day and about 4,000 open interest about a year and a half ago to now it's north of about 2,000 lots per day trading and somewhere in the range of 34 to 35,000 open interest. So it's something that we're very excited to finally be able to bring to a level that kind of resembles what gold and silver look like on the screen. So for a very long time, the screen presence was pretty weak. But that's one product that I'm very excited to talk about, especially given that there is a three exchange dynamic that goes on in the copper futures side. So in the copper future world, there's CME, which is obviously North American based, LME, which is London based, and then Shanghai Futures Exchange, which is Asia. And you would typically see that there are regional pricing differences. So our contract here at CME is a North American price. LME has global delivery points, and SHFE is a very much an Asian-centric price. You would typically see regional dislocations, and as a result, you would see a three-exchange arbitrage in copper futures. It really wasn't until perhaps maybe 6 or 8 months ago that this type of arbitrage could really be done on the options side. So only recently, Shanghai launched their options contract, which is doing well by early standards. LME has been the long-standing place where copper options are traded, and now CME being kind of the fastest growing and kind of like the most transparent and liquid way to trade copper options is also very viable. So we're starting to see a really interesting dynamic play out where there is quite a lot of friction between the markets and how they trade by convention. We trade premium-based here. LME trades volatility-based. The expiration dates don't perfectly line up. The contract specs, they measure in metric tons. We measure in pounds. There's just all these little frictions that do open up opportunities to do arbitrage trading. And one of the really exciting ones that's starting to present itself is the arbitrage between Asia and London and North America. Right now, I would characterize that the London and the North American vol surfaces pretty well correlated. Right now, we're trading the low 20s range for both London and the U.S. And from time to time, there could be a 1 vol differential, and that's considered pretty big. However, we're seeing the nature of the market making out in Asia, implied vol is being priced dramatically lower than the other two exchanges. Right now, I would say that we're in the low 20s, and right now I just peeked this morning. The implied vol on the SHFE options is actually only 16%. So there's a very, very large discrepancy in what's going on in there. And it looks as though it's just early days and no one is really set up to do a 3-exchange option arbitrage quite yet. So I'm very interested to see how that plays out. I think it's very positive for all 3 exchanges and to a greater extent the copper option trading world. But it's something that we're paying close attention to. We're out there trying to get the word out that this is a very, very liquid and viable product. Many of our flagship market makers have really fully adopted it, and it's something that I'd really like to get more eyeballs on, so to speak.
Yeah, it's not an area we get to talk about a lot. Obviously, a lot of the futures action out there driven by just what's going on with the Chinese demand story. A lot of that obviously driven by the trade war impact a lot these days. So copper, one of those interesting metals out there. Looking at it right now, another week and a little bit of softness for copper. Looks like it's about 272 or so out there in Copperland, off nearly 3% out here for the week. Found some funky strikes out here. Vol also kind of a bit of a mixed bag, kind of a little bit off in the near term, a little bit bid up actually in the longer term. Maybe thinking some of this tumult will last a little longer. Interesting. Obviously, the strikes here are kind of interesting. 2.98 calls are where the lion's share of the action was this week. Indices out there on CME, lighting it up. Let's see, which day did they go up? Mostly today and Tuesday in equal blocks, 2.98. Weird strikes out here. I don't know, Mr. Nick, we don't get a chance to talk. I know you love your gold. We don't get a chance to talk the non-precious metals here on the show too often. Sounds like CME very much growing its presence here in the copper options. I'm sure it sounds like you have a lot more users over there in Quick Strike land coming to you for copper options data. What are your thoughts here on what's going on in copper here these days?
Albert and I have been talking lately a lot just about people that are actually starting to look at copper and wanting both historical information that we have available with the new data mine and quick vol product, as well as the ability to continue to get end of day volatility curves, both strike based and delta based curves. So even though this doesn't always fall into the category of the products that copper is something we mention every once in a while. Part of the reason we don't is because the numbers tend to be, not in line with things like gold and crude and the rates and the indexes and stuff like that in terms of the sheer volume of stuff that goes through and the magnitude of the open interest. But it's definitely, this has been probably the most interest that I've seen in an individual product over the last several years in terms of looking for multiple people at the same time looking for historical information and end-of-day volatility information. So I think that's a good sign for this market in general, that there's finally people that are going to start paying a little bit more attention to what's going on.
Speaking of paying attention, we got to pay attention to a few other product categories. You probably talk metals all day, but we got to add a few others on here, including equities have been lighting it up this week, very specifically in the volatility space. We've been talking for a while. The vol out there across the broad equity market, S&P, Russell, all of the above, and NASDAQ, has kind of been bid very much. A lot of the futures and volatility futures in particular in a lot of these products were extremely backward, indicating that something was afoot out there, something was causing a lot of vol. And a lot of people were speculating that it might have been earnings, might have been non-farms, or it might have even been the midterms. Sounds like the third one was indeed the charm there, because shortly after the elections this week, we saw vol, I think the technical term is get annihilated out here across the broad spectrum of equities. Coming into showtime here, we're seeing our old friends out here, the VIX cash right around 16.5 or so, and our old friend the Russell vol, aka the Russell VIX, aka RVX, right around 20.25. So we're seeing that spread a little bit shy of 4 handles, and I was actually above 4 handles. Well, I'll have to go look and do my charting, Sean. That seems like that was pretty historically wide to me. Usually we see it in like the 1.5 point to like 3 point range on the outside. So getting it around 4 points shows there was a significant discrepancy between Russell vol, aka small cap vol, and large cap, aka S&P vol, which is kind of interesting. As we're mentioning right now, vol is just kind of in the toilet, coming off across the board, even though Russell, as we're speaking, up about 25 handles coming into showtime for the week now. So up about not quite 2%, about 1.75%. So small cap, Sean, clearly feeling the love here post elections. Obviously, it's been a busy time for you, traveling around, talking all things Russell and seeing what people are interested in. What's been on your radar this week as people are trading it up out there in the equities, Sean?
Volumes are strong. Well, first of all, I wanted to welcome Albert to the show, and just great to hear you talking about metals. I'm CME alumni, so I probably sat not too far from you on the trading floor with the metals team there in Chicago, and just congratulations to the asset class that you guys have so successfully built in the last few years and the upside. So I just wanted to extend my congratulations to the metals team, first of all. Back to Russell, lots of volume, lots of distribution of that volume. We always say that the small caps have that insulation from the tariff wars, and have been the benefactors of the tax incentives here in the U.S. But again, these stocks are more volatile in nature, and that spread has widened between VIX and RVX, and it's showing that volatility. But one of the bigger headlines is the announcement that CME Group announced this week, and that is the launch of Russell 1000 and 2000 total return futures, which I'm incredibly excited about. The product is there's strong client demand for total return futures. It's hitting the mark on a sector in the market that has been asking for this for a long time. Cleared total return futures are an opportunity for margin efficiencies in this space, and it's just going to be exciting to watch these products take off at CME Group.
Really quickly, Sean, some of our audience who may not be familiar with the concept, get them up to speed. What the heck do you actually mean by a total return future? How does that differ from your regular old Russell 2000 future, sir?
They're based on total return indices, so they have different product specs. But if you go to cmegroup.com/ I think it's total return, but if you just go /equities and click on them, you can see the product specs and see what the differences are between the futures. But it's primarily based on the index values are based on a total return index rather than the actual index of the actual 1,000 and 2,000 indices.
And those are obviously the futures are just launching. We have plans for maybe options in the distant future, sir.
That would be a wonderful thing. It's all part of that evolution.
Would be.
Client demand for futures come first, and then client demand for derivatives of those products comes next. So let's get those products up and running. Let's get lots of volume and open interest. And as CME sees the client demand, they answered to their clients. So.
Speaking of growing demand, looking here at the E-mini Russell 2000 options for this week, growing again, up nearly 16%. Go figure. People want to trade Russell 2000 options when things are lighting it up out there, when vol is getting annihilated, and that's pretty much what we're seeing again this week. By the way, the skew, as we were mentioning earlier out there, things were, as you might expect, heading into the earnings, I should say heading into the midterms. People were a little concerned, a lot of downside concern. We saw a lot of system shocks to the market over the past couple of weeks too. So puts were very rich coming in this week. That bid to the puts has pretty much gotten whacked, I think is the technical term out there. And the calls were kind of crushed. Those are out, and I'll get you a little bit of a bid as well. Not surprising, as we're moving up the skew chain as well, we're going to see some of that happen as the skew tends to rotate as we're moving up and down the curve there. In terms of what's lighting it up, the Russell, I should say, coming in right about 1575 into showtime, 16 half calls. Out here in November, taking the lion's share here with number two. Actually, I'll take that back. It was the 12-10 puts out here in November here that are doing the lion's share of the volume. All of that pretty much on Wednesday. Big print going up on Wednesday, which is interesting. So maybe a little bit of post-election. Doesn't look like that's closing. Looks like that's opening too. So doesn't look like a little bit of opening. So opening, post-election put love out here, or put dance perhaps. You don't know if they were buying out here in Russell. Mr. Nick, anything catching your eye? It's been kind of fascinating to watch just the vol annihilation post-election day. I know you had a lot on your mind on election night, but now that we're past it a little bit, anything catching your eye out here in just the volatility tumult we've seen across the board in equities this week?
Unmuting right now. Unmuting. Anything catching my eye? So let's see. So for people out there that are using the quick strike where you can click on the different cells within the TWIFO report, the main number in each box that tells you the change in volatility, the change in open interest, the new one for the at-the-money volatility. If you click on it, it'll now bring up a comparison curve where it'll show you last Friday versus where last Friday's curve versus where the curve is today. And we've been talking lately about how volatility is moving, right? We're trying to say, give some context to whether that volatility is shifting the curve or whether it's a sliding along the curve and that type of thing. And what it looks like this week is that we just sort of saw a little bit of movement. We saw like a 25 point change in the at-the-money, so not much of a shift from an at-the-money standpoint. But basically, we just saw that, like I think you said it, the crushing, right? We just saw the vol get pressed down. So we didn't see much change in the skew at all, but we saw just a pushing down of the volatility curve. So vol got hit. So it was a true kind of knockdown in vol after we had, it's been an interesting week in terms of the movement and where it's all gone and the news and all that kind of stuff. There's some event risk, obviously, with the Tuesday election, that kind of thing. But we just saw vol get hit from last week, plain and simple. We did see. I'm looking at the Russell in particular. The puts, there wasn't much. Well, the puts, there was a little bit more firmness from a 25 delta standpoint, and the calls, pretty much nothing changed. So that's sort of confirms the fact that we just got pressed down. So we didn't really see too much happening with just the change of the shape of the curve, that type of thing. If I jump over to the minis on the S&P, we're going to see probably, I'll take a look over here at the 29-day, which is closest to our 30-day expiration. In this case, we see a little bit difference. We see the puts got a little firmer from last week and the calls got a bit offered. So we did see a little bit of a pivoting shift there. So the at-the-money didn't change all that much, but we saw a little bit of well, the at-the-money did change. It got a little bit higher. So I guess we're about 75 higher from the week. So we slid down the vol curve, so that probably accounted for about half of the change in the volatility, and then we saw a little bit of a tilting mean. We got the calls got pulled down and the puts got put up. So we saw a little bit of a shift down in the overall vol, but we saw a change in the curve as well. So, I mean, that's the kind of stuff I find interesting, and I think the audience does like the volatility conversations we have, because we talk about it a lot, but it's always, for me, it's always even more enjoyable to just sort of see where the volatilities come from, whether we're paying for the volatility, all those kind of things. So we have to talk more about rent, I think, in the future, like we've discussed in the past, so we can say, hey, has it been worth owning stuff? Just like we talk about in gold, where we think it's worth owning options at low volatilities, that type of thing. But that's what I'm seeing in the index for this.
Yeah, the audience can't get enough of equity volatility here. So maybe I like that, bringing that rent concept, which we should play around with in the metals and crude and a few other places. Bringing that rent concept, is it paying for the rent to the equities, I think might be fascinating. Speaking of equity volatility, really quick, Sean, you guys over there, Russell, you need to get the data team, the research team out there. They need to start tracking that RVX VIX spread, sir, because that's interesting data. And then they could give me the numbers, which would mean I don't have to do it, Sean. I like that. How do you like that idea, Sean?
I got to say it. If you talk to another one of my very important partners, and that's CBOE, they track this for you. So CBOE Global has that information, and moving forward, I'm happy to share some historical data there and talk more about that spread. But it's definitely something that there should be definitely more attention brought to it.
Yeah, that's those products we like. We want to see RVX get lit up again. We like that product. We talked about it a lot on this network back in the day, and how it compares to broad S&P volatility is, I think, the question everybody has. So one we have on our mind. Speaking of your questions We'll get to those in a minute, listeners. We'll do a real quick jumping because I know everyone's talking crude these days. We got to hit crude really quickly. Another of Mr. Nick's favorites out here. Obviously, the crude taking it on the chin this week. It's off 21% from its 52-week high, which was a 4-year high pretty much, actually, from last month, putting it officially into bear territory out there. Obviously, Iran sanctions kicking in this week, even though there were some exceptions to that, which kind of made it a bit of a mixed bag. We're also seeing Chinese crude imports hitting a record, which is kind of interesting, 9.61 million barrels per day. So a lot of interesting mixed messages, but all that weighing on crude, we're at about 60.5, off about 2.5 handles and nearly 4% coming into showtime here this week. And in terms of what's lighting it up, we're seeing vol getting a little bit juicy out there. As you might imagine, puts have kind of been bid out here in crude for a while, and we're seeing that kind of play out a little bit across the term structure as vol getting a little bit richer, as people are saying, what's going on out here? What's happening? How will these sanctions play in? How will the growing stockpiles here, imports overseas, how will all that kind of play into the Texas tea that is WTI in terms of what was lighting it up out here? Really quick, number one with the bullet, the looks like D60 puts, not surprising there, 36,000 of those bad boys lighting it up this week. So those are number one with a bullet by a country mile out here. If I can pull it up really quickly, there we go. 15,000 of those hitting the tape today, 15,500. It's pretty much almost half of that volume coming up today. Nearly 10,000 on Tuesday, right after the wake of the sanctions coming in. So a lot of action out there in the front month out of the money puts. Let's go here a little bit farther out here to double puts in Jan, doing about 12, almost 13,000 this week, and 13,000 also the 90 calls out here in March. So it's not all downside, listeners, but it's a lot of downside. Again, reflecting that put bid. The 90 calls also active here in DEES 2019. So 7,200 of those bad boys lighting it up. And if that's not far enough out of the money on the put side for you, the 40 puts in DEES 2020 lighting it up to the tune of 1,600. This week. All sorts of funky paper. Really quick, Mr. Nick, anything catching your eye in crude before we bring the listeners back on?
Just talking about the vol and kind of touching on the shape of the curve and that type of thing. Obviously, we've been talking the last couple of weeks about it, how we hit a high of 75 plus in the crude, and we've been nothing but down since then. And we talked about a continuing. When we got to that 65 strike, we sort of hit it and stuck around. Then we went through it. We got a little bit of a pop, and then we talked about whether we were going to continue to trade around. We sort of established a new 60 to 70 range that we talked about. And now here we are down near the 60 again, which was our next highest open interest after the 65. So the slide has continued, and we really didn't see much of an increase in the volatility until, we kind of reached these new kind of intermediate lows. But again, a lot of this move is along the shape of the vol curve in terms of the firmer volatility. But we are seeing a change in the shape of the curve here a little bit, where the calls are a little less offered than they were. Not a tremendous amount, but just a little bit of a tilting up on the call side. But I'd say this vol move is more along the curve than it is pure bid and volatility. So that's pretty much what I'll say for here.
And speaking of saying things, it's your guys' turn to do just that. It's time to get into a little bit of the futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, we're kind of up against this. I'm going to have to burn through some of these really quick. You guys send in great questions. Keep them coming. We love it. We just got started a little late today. Let's say Romansray saying crypto is a myth. Okay, some people are on that train. Others clearly not, because there's volumes out here lighting it up like crazy. So that's what makes a market, right? Everyone having both sides of this. Here, what do we got here? Sean, this one's for you, sir. This comes from Delman. Delman says, those Russell buy right indices you discussed on the last show, what are the tickers Can I trade them directly, and are there options listed? Wow, a bunch of questions. 3 questions here for you, Sean. So hit them in any order that you can, sir.
SIBO calculates these indexes. There's not options that trade on them. There are other products, listed securities that trade in various places. That's all on the SIBO's website. So I would direct you there to look at the various buy right indices. They have a list of them right on their website. They're easy to find, and come back to me if you need anything in regards to information. Happy to email you the link or whatever. My email address is smith@FTSERussell.com. That's smith@FTSERussell.com. Happy to help you there.
All right, there. Hit the man up with your questions directly. Last but not least, we got time for one more. Albert, this is up your alley. This comes from Talerico. They want to know, does the use case for weekly options differ by product? So a crude weekly use case, does it differ from metals and from ags? Albert, you kind of were just breaking down earlier in the show that you're seeing a lot of love for the near-dated kind of short duration contracts in the metals. Maybe what are some of the use cases that you're seeing for that? And then maybe if you have any comparing and contrasting you want to do there, sir, feel free.
Yeah. So really great question. To answer the shortest answer to that question is yes, there are different use cases, especially between ags and energy and metals. I mean, one of the ones, a very, very obvious use case today would have been if you suspected that the FOMC action today would have been different. You might have wanted to buy either some puts or calls, and getting them at a kind of like a lower premium to not have it as long would have been perfect, because the announcement would have came out this afternoon and your option expires tomorrow afternoon. So in terms of what they're used for in the precious metals, it really revolves around dates, right? So FOMC is a major date for gold. FOMC is less of a concern for ags, where you might be looking at crop numbers or kind of like livestock type numbers. In the energy world, OPEC is something that short-dated options really revolve around. So the use case really revolves around what is the major indicator that's very popular to that asset class that moves it, and then in what frequency does it happen? There are times where OPEC might coincide with FOMC, kind of like if it does. But I would say that what is most driving to that industry is what's going to be driving people to the short-dated options. And in general, I've found that short-dated options are typically popular in all times of the year. It's not just around FOMC dates, but if you had a short-term opinion, the weeklies have been very, very popular in gold, at least.
All right, we'll have to leave it there. Actually, we'll leave it here with this, Nick. You're getting some love here in the chat. Our buddy Mark Brandt congratulating you and as becoming first man there of Illinois House District 48. He's also saying he really likes euro dollars. They think they have the highest at-the-money implied volatility of any future. So there you go. A little bit of congratulations, a little bit of love, and a little bit of talk. We didn't get a chance to talk euro dollars on the show this week, but I'm sure we'll get to them on a future episode. All right, listeners, that music means we have come to... Amazing how quickly the show flies by when we're having fun here. But that means we've come to the end of another epic journey through the world of all things futures options. Before we go, let me go back around the horn. Let me start with our guest here, Albert. Albert, first off, well done. You made it. You survived a full hour, so well done, sir. And secondly, if you want to leave our audience with a little bit of a hint, a little bit of a tease of what's coming down the pike from you guys and your metals team over there at CME, now is the time, sir. The floor is yours.
Yeah, thanks. So it was really enjoyable to be here. Really enjoyed the conversation. And just one of the things that we're really looking for from the customers is feedback. Anything that is out there on the minds of customers. My email address is albert.ng@cmegroup.com. Would love to hear if you have suggestions on how we might be able to improve the option markets. For the time being, we're really working on short-dated options, really working on copper options, and anything that can help that grow is something we're looking to hear about. So we'd love to hear from the customers.
And if people want to reach out to you directly, how do they do that, Albert?
The best way would be email, albert.ng@cmegroup.com.
There you go. Hit the man up, albert.ng@cmegroup.com, or head on over to cmegroup.com. Click on the metals page while you're there. While they're clicking on websites, Mr. Nick, you guys have a lot of stuff cooking over there in Quick Strike, sir. What do you have in store for us this week?
Where am I? I'm not muted, so there you go. What do we got going on? Got like I mentioned last week, I think our new tools are coming out very shortly on the CME site. So we'll have some economic calendar information and some and some event vol calculator tools out there. And then after the next few weeks, we'll have some other announcements that we could push out there as well. And we did mention, I can mention it again, OPEC Watch version 2 will be coming soon as well. So just in time for the next meeting. So keep an eye out for that.
There you go. Keep an eye out. You know where to find it. Bantix.net, of course, is the place to go. And just click on the login to QuickStrike or try the QuickStrike trial if you haven't done so. Again, if you're trading this stuff, you're not using this. I don't really know what you're using. I guess the old Abacus is your preferred. Maybe the old Texas Instruments TI-80 machine out there is your preferred go-to. Either way, check it out. QuickStrike.net to learn more. And, of course, give him a follow on Twitter as well. QuickStrike, QuickStrike1 on the old Twitter machine to see all this cool data we're talking about as he tweets it out throughout the week. And last but not least, Mr. Sean, while you're traveling hither and yon, sir, what can we look forward to in addition to all that cool volatility data? What else can we look forward to coming from the FTSE derivatives team, sir, in the coming weeks?
It was great to talk to VIX RVX today. So thank you very much. I think we brought it up last week at the end of the show because we hadn't talked about it. So glad that came up today. Number 2, CME's new total return index futures coming out in December. Again, these are, I actually went to the website. So yeah, if you type in cmegroup.com/total return, the total return index suite of products comes up, and you can get information about the Russell 1 and the Russell 2 total return futures, and how they trade and how they're going to be trading in blocks and BTIC type of scenarios. So all of that kind of information is on the website. But, our partners are just fantastic at creating products that have client demand. And the CME is so good at responding to clients and their information. I think Albert has mentioned this several times today as well. The CME provides solutions to problems, to pain points customers have, and that response comes with product innovation and answers to their questions. So very, very much looking forward to seeing these products take off in December.
There you go. Check it out, cmegroup.com or FTSERussell.com, FTSERussell.com. Give them a follow over there on Twitter if you haven't done so as well. A lot of good data coming out of there. Since we're talking URLs, I think I might have said Bantix.net before. I meant Bantix.com, Bantix.com, of course, is where you get your QuickStrike trials, where you kick the tires and light the fires, as they say. And on behalf of Albert and Nick and Sean and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. We'll get to more every episode, I promise you. And we'll see you next week for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.